Hello and Happy New Year. This is Andy Michael with Seven Springs Wealth Group. I want to share a few thoughts on the market as we look into 2024. First, let's talk about what happened in 2023 and really what happened over the last 3 years. What we find in U.S. equity markets in particular is that returns were somewhere around 30% cumulative, which was 8 to 10% annualized returns. Even though it was a very wild and bumpy ride to get there and looked different whether you were in growth stocks or value stocks, you ended up in roughly the same place. However, that story in fixed income was very different, as we still have not recovered returns over the last 3 years in fixed income. As rates went from nothing to something, we saw bond prices decline and still have not fully recovered. That's a different starting place, though, where we look 3 years into the future, because interest rates are now starting at something. So don't think the next 3 years will look like the last 3 years in fixed income. If we think about 2023 and how risk assets did, equities here, high yield here, what we find is double-digit returns. That compares to cash that had about a 5% return in 2023. That cash return felt very, very good. It was stable. But just remember, even in a year when cash offers 5%, you still want and need some of those risk assets that can offer double-digit returns. Lastly, let's look at the next 12 months price to earnings for equities going forward. We find a very fragmented market where there are some more expensive parts of the market like Russell 1000 Growth or NASDAQ. Think those top 10 companies compared to the more value names such as the Russell 1000 Value, international stocks with much more lower valuations. And so it's still a fragmented market in terms of valuations going into 2024. If we think about the last 4 years, what a chaotic ride it's been. From the shutdown of the pandemic to reopening and inflation and supply chain issues to then interest rate hikes, fastest in the 40 years to contain inflation. And then artificial intelligence really dominating the headlines last year. What's going to happen in 2024 is anyone's guess, but just to use an example, Dr. David Kelly of JP Morgan suggests 2024, 2% growth, 0 recessions, 2% inflation, 4% unemployment. My bigger takeaway here and why I use this scale is that 2024 could present an opportunity to have a more normalized year compared to the wild and chaotic years we've seen over the last 4 years. And if we do end up with a more balanced and more normalized year, that in and of itself will feel strange after having such wild rides in markets and the economy over the last 4 years to get to this point. So if we think about the markets list, I have a wish list and a risk list. In the big picture, all of these things that you see on the wish list, this is what the market typically wants. When the market gets these things, you typically have calmer years in the market that move up and to the right. I think about 2017 and 2019 as the market getting a lot of these items on its wish list. On the other hand, the risk list, when these things are coming into the market, massive unknown unknowns like a pandemic, or high inflation or recession risks or higher interest rates. Think 2020 and 2022. We can see large drawdowns in the market. We can see multiple compressions, those numbers we looked at before, coming down. And we can see elevated volatility in the market. The reality is we'll probably have some combination of all of these things throughout all of 2024. But framing it this way gives you an idea of when you see the market behaving in one way or another, it's probably because it's either getting items on its wish list or it's having items take place on the risk list. A few takeaways for this year. 2024 will probably not look like 2023 or the last 4 years for that matter. It's a new year, a new narrative. The things that happened to get us to this point are now in the past. The future is still unknown, but don't look to the past to try to project out the future. Maximize your cash yield. We still have treasury bills, money market funds yielding over 5%. Get that while it's here for as long as you possibly can for your cash reserves. Be prepared for double-digit market swings. Since 2008, the S&P 500 has ended the year double digits higher or lower than where it started the beginning of the year. So it's actually not a high probability that we'll have a nice single-digit return up 7 or 8% for the year. It can certainly happen, but history says the market will probably move up or even down double digits at some point throughout the year. Finally, vote at the ballot, not in the market. I put this chart over here from JP Morgan. What it shows is real GDP is positive on average throughout Republican, Democrat, or divided government eras. As are market returns, they are positive on average, whether you have an all Republican, Democrat, or divided government. So by all means, go to the polls this year and vote, but just make sure you leave that out of your market and portfolio decisions. I hope this is helpful for a few takeaways going into the new year. Please reach out with any questions. Thank you so much for watching, and we'll see you again soon.